There are two sides to every market, the side of the winner and the side of the loser. They trade the same securities, watch the same ticker tape, and are subject to the same fundamental forces of greed and fear. Yet their results are perpetually and often brutally different. The difference is not a matter of luck, nor is it a matter of possessing some secret, unknowable information. The difference lies in a set of timeless, fundamental principles of thought and action. It is a method. For the speculator, the market is not a game of chance to be played with hopeful abandon. It is a serious, intellectual, and psychological endeavor. It is a business, and like any business, it has its own unwritten laws of success and failure. No one in the history of Wall Street understood these laws more intimately or paid a higher price for breaking them than Jesse Livermore. His life was a grand, dramatic testament to both the spectacular heights that can be achieved through disciplined speculation and the catastrophic ruin that results from abandoning those same principles. He was, at different times, both the ultimate winner and the ultimate loser, which makes him the ultimate teacher. His entire career was a real-world laboratory for discovering and testing the critical distinctions that separate the professional operator from the amateur gambler. What follows is not merely a history, it is a deconstruction of his method, an exploration of the 12 fundamental differences between a winning and a losing speculator, as learned and articulated by the greatest of them all. To begin this journey, one must first acquire the proper mental toolkit. The single greatest resource for understanding the mind of a master speculator, the psychological challenges, the emotional discipline, and the hard-won wisdom, is not a modern textbook but a timeless masterpiece. To truly comprehend the world that Livermore operated in and the internal battles he fought, one must read Edwin Lefebvre's 1923 classic, Reminiscences of a Stock Operator. This is not a dry biography, it is a living document, a direct look into the mind of its protagonist, Larry Livingston, the thinly veiled prototype of Jesse Livermore himself. It is a book that transcends time because it decodes the unchanging nature of markets and men, revealing the psychological traps that have destroyed speculators for centuries. But how can a century-old text be applied in today's high-speed markets? The original wisdom, while profound, can feel distant. For this reason, the single most valuable resource for the modern operator is the new 2025 Annotated edition, Reminiscences of a Stock Operator, an in-depth chapter-by-chapter analysis for the modern speculator by Max Davidson. This is not just the original text, it is a complete translation of its timeless wisdom. Max Davidson's detailed commentary in each chapter acts as a bridge across the century, making every one of Livermore's hard-won lessons immediately powerful and accessible for the trader of today. A link to this essential edition has been provided for you in the description below. It is the definitive guide to the psychology that every master must conquer. Difference number 1. The professional's plan versus the gambler's impulse. The first and most fundamental distinction lies in the operator's approach to the market itself. The losing man treats the stock market as a game of chance, a casino where he comes for the thrill of action. His decisions are driven by impulse, by boredom, by the intoxicating desire to make a quick and easy profit. He has no underlying plan, no strategic view of the broader economic conditions. He is a gambler, and like all gamblers, his fate is ultimately determined by the laws of probability, which are firmly on the side of the house. The winning speculator, as Livermore learned from his earliest days, treats the market as a serious, full-time business. It is an intellectual pursuit that demands constant study, preparation, and the formulation of a clear, evidence-based plan. Before a professional operator even considers an individual stock, they first form a definite opinion on the state of the overall market. Is the broad market in a bull phase or a bear phase? Are the underlying economic conditions favorable or unfavorable? Livermore called this identifying the line of least resistance. He knew that attempting to swim against the great tide of the market was a fool's errand. The majority of stocks will move in the same direction as the overall market. Therefore, the first step in any campaign is to correctly diagnose the primary trend. This requires a study of macroeconomic factors, of credit conditions, and of the behavior of the market leaders. It is a top-down, strategic assessment. Only after establishing this general view does the professional begin to look for specific opportunities. The amateur looks for a single stock to bet on. The professional looks for a favorable market in which to operate. This difference in approach is the difference between a random, hopeful punt and a calculated business operation. Difference number 2, reading the tape versus following the crowd. The second great distinction lies in the source of information that guides a speculator's decisions. The losing man is a creature of the crowd. His mind is a vessel for the opinions, the rumors, and the narratives of others. He is perpetually seeking tips. He listens to the advice of his broker, his friends, and the pronouncements of so-called experts in the newspaper. He believes that someone, somewhere, has access to secret information that will make him rich. He does not understand that by the time a tip reaches him, it is no longer a tip. It is a public advertisement. As Livermore stated, the stock market is filled with individuals who know the price of everything, but the value of nothing. The loser is obsessed with these prices, with these tips, but he has no independent basis for his actions. The winning speculator, by contrast, is a self-reliant lone wolf. He trusts only one source of information, the objective, unbiased, and undeniable evidence of the ticker tape. For Livermore, the tape was the ultimate truth. It was the unfiltered, minute-by-minute record of the real battle between supply and demand. The price action and the accompanying volume told a story that was far more truthful than any newspaper headline or any broker's enthusiastic recommendation. He learned to read the tape not as a series of random numbers, but as a language. A stock that is being quietly accumulated by informed interests will have a specific feel on the tape. A stock that is being aggressively distributed will have another. He did not care about the why. He did not care about the news or the earnings reports, which he knew were often delayed or misleading. He cared only about the what. What is the stock doing right now? Is it acting strong or is it acting weak? His decisions were based on this direct empirical evidence. The loser seeks validation from others. The winner seeks confirmation only from the market itself. Difference number 3, following the trend versus calling the turns. The third distinction is a direct consequence of the second. Because the loser is driven by emotion and opinion, he is constantly trying to impose his will upon the market. The winning speculator, because he is guided by the tape, seeks only to align himself with the market's own expressed will. The loser is perpetually engaged in the ego-driven and ruinous game of trying to pick exact tops and bottoms. In a powerful bull market, he will constantly sell stocks short simply because, in his opinion, they have gone too high. He is arguing with the tape, a battle he is destined to lose. In a bear market, he will constantly buy stocks because they look cheap relative to their previous highs, failing to recognize that the underlying trend is against him. The winning speculator, as Livermore made clear, understands that the big money is not made in the small, day-to-day fluctuations, but in the great sweeping primary moves. His entire objective is to correctly identify the start of one of these major trends and to ride it until its conclusion. He is not a bottom fisher or a top caller. He is a trend follower. He understands that the line of least resistance is the most powerful force in the market, and his job is to find it and to get on board. This requires a profound shift in mindset. It is about abandoning the ego's desire to be the brilliant hero who calls the exact turning point, and instead adopting the humble professional discipline of following the market's own lead. As Livermore noted, it was never my thinking that made the big money for me. It was always my sitting. The sitting refers to his ability to patiently hold a position that was aligned with the primary trend through all its minor, confusing corrections. Difference number 4. Buying strength versus buying weakness. This is one of the most counterintuitive and critical differences. The losing man, conditioned by a lifetime of shopping in the real world, is a natural bargain hunter. He is psychologically drawn to stocks that have fallen significantly in price. He sees a stock that was once $100 and is now $50 and thinks he is getting a 50% discount. He does not stop to ask why the stock has fallen. He is buying weakness, hoping that it will turn into strength. This is a consistently losing strategy. A stock at a 52-week low is usually there for a very good reason. It is a weak stock in a weak position, and it is more likely to continue to fall than it is to reverse. The winning speculator Livermore taught does the exact opposite. He buys strength. He is not interested in bargains. He is interested in leaders. His primary entry signal was the pivotal point. A pivotal point is a critical price level, often a new all-time high, where a stock breaks out of a long period of consolidation. For the amateur, buying a stock at a new all-time high feels like the riskiest possible action. It feels like buying the top. For Livermore, it was the safest and most logical time to buy. The breakout into new high ground was the market's own, unambiguous signal that the stock was in the hands of strong buyers, that all overhead supply had been absorbed, and that the line of least resistance was now decisively upward. The pivotal point was the moment of confirmation, the point where the risk of being wrong was at its lowest. By buying strength, the speculator ensures that they are immediately aligned with a powerful market-validated trend, rather than making a hopeful bet on the reversal of a demonstrated failure. This habit of disciplined observation, of seeing the market not as a random collection of stocks, but as a structured campaign of advancing and retreating armies, is the first great habit of the winning speculator. To continue forging this professional mindset, to learn to see the market as the masters did, subscribe to this channel and click the notification bell. Difference number 5, confirming the thesis versus going all in. The fifth distinction lies in the initial approach to a new position. The losing man, when he gets an idea or a hot tip, is often overcome by greed. He sees the potential for a massive quick profit and wants to maximize it from the very start. He will often commit his entire available capital to the trade in a single, impulsive, all-in bet. This leaves him with no flexibility, no room for error, and exposes him to the maximum possible risk from the outset. It is a strategy of pure hope. The winning speculator, Livermore demonstrated, approaches a new idea with the caution of a scientist testing a hypothesis. He never took his full intended position at the very beginning. Instead, he would use probing positions. He would first establish a small initial position to test his judgment. This was his probe, his scout into enemy territory. He would then wait and watch the market's reaction. If the market moved in his favor, even by a small amount, it was a piece of confirming evidence. It was a clue from the tape that his initial reasoning was sound. Only then would he add to the position. If, however, the market moved against his initial probe, it was a clear signal that his timing was off, or his entire thesis was wrong. He could then exit this small exploratory position with a minimal loss and wait for a better opportunity. This method ensures that the speculator only commits their full capital to an idea after the market itself has provided confirmation that the idea is correct. It is a disciplined, evidence-based approach that stands in stark contrast to the amateur's hopeful all-in gamble. Difference number 6, focusing on leaders versus diversifying into mediocrity. The final difference we will explore in this section concerns the allocation of capital across the market. The losing man is often told that the key to safety is diversification. He will therefore spread his capital thinly across a dozen or even dozens of different stocks in many different industries. While this may feel safe, Livermore argued it was often an act of indecision that guaranteed mediocre results. It is impossible for any individual to do the deep, focused work required to master so many different situations. The result is a portfolio of which the owner knows very little, a collection of mediocrity. The winning speculator, by contrast, practices concentration. Livermore understood that the big money in any major market move was always concentrated in a few key industry groups and the leading stocks within those groups. The market is not a monolith that moves up and down in perfect unison. It is like an army advancing. At any given time, some regiments, industry groups, will be leading the charge, while others will be lagging behind or even retreating. The job of the speculator is to identify which groups are at the vanguard. He would wait for a primary bull market to be confirmed, and then he would look for the strongest industry groups within that market. Once he had identified the leading group, he would then focus his analysis and his capital on the one or two leading stocks within that group, the ones showing the most powerful price action and breaking out of their pivotal points. This method of concentrating his bets on the market's proven leaders ensured that his capital was always working in the most powerful and profitable part of the market. It is a strategy of active, decisive leadership, not passive, hopeful diversification. We have now established the 6 core principles of analysis and initiation. But the true test of a speculator comes after a position is established. It is in the management of risk, the scaling of profit, and the mastery of the human heart that the greatest fortunes are truly won or lost. Having established the 6 core principles of analysis and initiation that separate the winning speculator from the hopeful amateur, we now turn to the most critical phase of any market operation, the management of an open position. It is here, in the crucible of active risk, of unfolding profit and potential loss, that the true character of an operator is revealed. The initial analysis may be brilliant, the entry perfectly timed, but it is in the moments that follow, the decisions made under the immense psychological pressures of greed and fear, that fortunes are truly won or lost. The final 6 differences are not about finding a trade. They are about surviving it, maximizing it, and mastering the human heart, the speculator's greatest and most treacherous enemy. Difference number 7, pyramiding into strength versus taking small profits. The 7th and perhaps most financially significant distinction lies in the operator's behavior once a trade becomes profitable. The losing man is governed by fear. The moment a stock moves in his favor and shows him a small profit, his primary emotion is an intense anxiety that this profit will disappear. He is terrified of a winning trade turning into a losing one. This fear compels him to act prematurely, to snatch a small, quick gain to secure the positive emotional feedback of being right. In doing so, he consistently cuts off the potential for a truly life-changing trade. He is the man who buys a stock at 50, sells it at 55 for a quick profit, and then watches in a state of agonizing regret as it goes on to 150. As Livermore noted, men who can both be right and sit tight are uncommon. The amateur can often be right, but he can almost never sit tight. The winning speculator, by contrast, understands a profound truth. The vast majority of a campaign's profit comes from a very small number of trades that experience massive, multi-month trends. The entire purpose of his method is to identify and capitalize on these rare events. Therefore, his behavior in a winning trade is the polar opposite of the amateur's. He does not take small profits. He builds a massive position. This is the art of pyramiding. For Livermore, a trade that moved in his favor was not a reason to exit. It was a reason to become more aggressive. It was the market itself providing confirmation that his initial judgment was correct. He would use this confirmation as a signal to add to his position, to press his advantage. His method of pyramiding was, like all his rules, systematic and disciplined. He would never add to his position simply because he was optimistic. He would only add when the stock, in the course of its primary trend, passed a new, secondary, pivotal point. For example, if his initial entry was a breakout at $50, he might wait for the stock to rally and then consolidate in a range between, say, $58 and $62. The breakout above the $62 level would be a new pivotal point, a fresh signal of strength. It was only at this moment of reconfirmed strength that he would add a new line of stock to his core position. His rule was to always make sure his average cost was below the current market price, and to never add to his position at a price higher than his last purchase during a single advance. This disciplined step-by-step process of buying strength allowed him to build the largest possible position with the lowest possible risk, using the market's own momentum to finance his increasing exposure. It is an act of supreme confidence and courage, a mindset that shifts from the fearful question of, how can I protect my small profit, to the aggressive question of, how can I maximize this extraordinary opportunity? Difference number 8. Cutting losses ruthlessly versus averaging down. If the amateur's greatest mistake in a winning trade is fear, his greatest mistake in a losing trade is hope. This brings us to the 8th distinction, the one that most clearly separates the professional survivor from the amateur who is destined for ruin. The losing man, when a stock moves against him, is paralyzed by the pain of admitting a mistake. Instead of selling and accepting a small, manageable loss, he holds on, hoping that the market will reverse and vindicate his initial judgment. Worse yet, he often engages in the single most financially suicidal act a speculator can commit: averaging down. He buys more of the stock as it falls, reasoning that he is getting a better and better average price. Livermore viewed this practice with absolute contempt. He saw it as an act of pure, unadulterated ego, an attempt to prove the market wrong. He understood that a stock moving against you is the market providing you with clear, unambiguous information that your initial thesis was flawed. To buy more is to argue with the tape, to throw good money after bad in a desperate attempt to salvage one's pride. It is the practice that turns a small, recoverable trading error into a catastrophic, portfolio-destroying disaster. The winning speculator's approach is the surgical opposite. His doctrine is one of ruthless and unemotional loss-cutting. For Livermore, this was not a matter of debate. It was a mathematical and psychological necessity, codified in his famous 10% stop-loss rule. This was his ironclad, non-negotiable law of survival. Any position without exception that moved against his entry price by 10% was to be liquidated immediately. This was not a guideline. It was an absolute. The reason for this rule was twofold. First, it was a matter of simple mathematics. A 10% loss is easily recoverable. A 50% loss, which is what can happen when one averages down, requires a 100% gain on the remaining capital just to get back to even. By capping his losses at a small, fixed percentage, he mathematically guaranteed his long-term survival. Second, and more importantly, the rule was a tool for killing hope. The 10% loss was a predefined logical decision made in a state of calm, designed to override the emotional paralysis that grips a trader when a position goes wrong. It was the ultimate ego killer, a mechanism for forcing himself to accept the market's verdict and move on. Difference number 9, treating losses as tuition versus taking them personally. The 9th distinction is a subtle but critical psychological one that flows directly from the last. It concerns the speculator's emotional reaction after a loss has been taken. The losing man takes every loss as a personal failure. He sees it as a direct reflection of his own intelligence and self-worth. This emotional response leads to anger, frustration, and the desire for revenge against the market. This often results in the disastrous practice of revenge trading, jumping immediately into a new, often larger and more reckless position in a frantic attempt to win back the money that was just lost. This emotional, reactive trading is a guaranteed path to ruin. The winning speculator, having already accepted that losses are an inevitable part of the game, has a completely different mindset. For Livermore, a small, disciplined loss was not a failure. It was tuition paid to the market for a valuable education. Each loss was a piece of critical information. It was the market telling him that his timing was wrong, his analysis was flawed, or that the conditions were not right. His response was not anger, but analysis. He famously kept a detailed log of all his trades, both winning and losing. After taking a loss, he would study it with the detached curiosity of a scientist studying a failed experiment. What was the mistake in his reasoning? Did he misread the tape? Did he enter too early? Did he violate one of his own rules? He sought to learn from every single error to ensure he would not repeat it. This mindset transforms a loss from a painful, ego-bruising event into a constructive educational experience. It is the scientific, detached mindset of a professional who understands that the path to long-term success is paved with the lessons learned from many small, well-managed failures. Difference number 10. Strategic patience versus constant action. The 10th difference lies in the operator's relationship with time and activity. The losing man is addicted to action. He feels that if he is not constantly in the market buying and selling, he is missing out. He is driven by a powerful fear of missing out, or FOMO. This compulsion to always be doing something leads to overtrading, taking low-probability setups and churning his own account for the benefit of his broker. He is a man who cannot sit still. The winning speculator, by contrast, is a master of strategic patience. Livermore's most famous and most profound quote is this: "Money is made by sitting, not trading." He understood that the great life-changing moves in the market are rare events. They do not happen every day or every week. The majority of the time, the market is a confusing, choppy, and unpredictable environment where the odds do not favor the speculator. The professional operator, therefore, must cultivate the discipline to wait. Livermore explained that there are two types of sitting. The first is sitting in cash. It is the ability to remain patiently on the sidelines, sometimes for weeks or even months, resisting the temptation to trade until the entire market environment aligns perfectly and a clear, high-probability, pivotal point setup emerges. The second, and even more psychologically difficult, type of patience is sitting in a winning trade. As we discussed, this is the ability to hold a position for the duration of a major trend, riding it through its inevitable and frightening secondary corrections. The amateur is constantly in motion. The professional understands that his greatest profits come not from his actions, but from his strategic inaction, from his ability to patiently wait for the perfect moment to strike, and then to patiently wait again for that move to reach its full potential. Difference number 11. Intellectual honesty versus arguing with the tape. This distinction strikes at the core of a speculator's relationship with reality. The losing man operates from a position of ego. He first forms a strong, often emotional opinion about what a stock should do. He then seeks out information that confirms his opinion and ignores all evidence that contradicts it. When the market moves against him, he does not question his own judgment. He concludes that the market is wrong, that it is being irrational, and that it will eventually come around to his superior point of view. He is, in essence, arguing with the ticker tape. The winning speculator operates from a position of profound intellectual honesty and humility before the market. Livermore's mantra was simple: the tape is the final arbiter. His job was not to have an opinion. His job was to interpret the evidence that the market was providing him in real time. He understood that his own analysis, no matter how brilliant, was merely a hypothesis. The price action was the experimental result that would either confirm or falsify that hypothesis. He was famous for his ability to change his mind in an instant. He could be aggressively bullish in the morning, but if the tape's action in the afternoon began to show signs of weakness and distribution, he could liquidate his entire long position and even reverse to the short side without a moment's hesitation. His loyalty was not to his own opinion, but to the truth as it was being revealed on the tape. This is the art of egoless observation. It is the understanding that a speculator's ego is his greatest liability, and that the only path to success is to surrender one's own desires and opinions to the cold, hard, and unforgiving verdict of the market. Difference number 12. Self-reliance versus seeking validation. The final difference is about the source of a speculator's conviction. The losing man is psychologically dependent on others. He is perpetually seeking validation for his decisions. Before he buys a stock, he asks his friends for their opinion. He reads analyst reports to see if the experts agree with him. He scours the news for bullish headlines that will confirm his bias. He needs the comfort of the consensus, the safety of the herd, because he lacks true internal conviction in his own judgment. The winning speculator is the ultimate lone wolf. Jesse Livermore trusted only two things: his own exhaustive research and his own interpretation of the ticker tape. He knew that by the time an investment idea had become the popular consensus, the great opportunity was almost always over. The big money was made by seeing the truth before the crowd did. This requires a profound level of self-reliance and the psychological fortitude to stand alone, often against the prevailing sentiment of the entire world. When he was building his massive short position in 1929, he was not being praised as a genius. He was being ridiculed as a fool who was fighting the greatest bull market in history. But his conviction was not based on the opinions of others. It was based on his own reading of the tape, which was telling him a story of distribution and exhaustion. He understood that the path to extraordinary results could not be found in the comfort of the crowd. It could only be found in the lonely, difficult, but ultimately rewarding practice of independent thought. In conclusion, these 12 distinctions form a complete and coherent portrait of the master speculator's mind. They reveal that the great divide between the winner and the loser is not a matter of intelligence or access to secret information. It is a matter of discipline, of mindset, and of character. The winning speculator has a plan, trusts only the market's action, follows the trend, buys strength, tests their ideas, and concentrates on the leaders. And once in a position, they pyramid their winners, ruthlessly cut their losers, treat losses as lessons, practice strategic patience, listen to the market without ego, and rely on their own judgment. Jesse Livermore's career serves as the ultimate case study. When he adhered to these principles, he was the greatest trader the world had ever seen. When his own human emotions caused him to violate them, they led to his ruin. His legacy is therefore a dual one, a timeless blueprint for how to win, and a tragic cautionary tale of the profound psychological challenges that every speculator must face in their quest to conquer not the market, but themselves.